Dear students, we will do module 69. This module is titled Computation of Capital Gain with and Without Indexation. Now you will be wondering why it is with and without indexation. See, now you know that the Income Tax Act is going through lot of changes. So here you have to remember one thing. As per the new Income Tax Act, they made one change, an important change in the capital gain concept. That is, they have abolished indexation benefit for computing LTCG for capital asset transferred on or after 23/7/2024. So this is an important date, 23rd July 2024. On or after, if they have transferred, an SSC can take two decisions. One is he can go for indexation and he can go for without indexation. Then he can decide whichever is getting the least taxability, he will select that accordingly. So without indexation meaning it's just like calculating short-term capital gain. First will be sale consideration will be there. Sale consideration will be there. Less expenses on transfer. Expenses on transfer. When you reduce this, you will get net sale consideration. Net sale consideration you will get. So here, if it's indexation, we will do index cost of acquisition and index cost of improvement. Here it will be cost of acquisition and cost of improvement. So here you have to remember there is no indexation in this case. So it's just like calculating short-term capital gain and you will get the LTCG. So now the SSC can decide whichever is beneficial for the SSC. So here one important point I want to tell you, that important point is indexation benefit on cost of acquisition and cost of improvement shall be available if the capital asset is transferred up to 22nd July 2024. Now first problem we will do. In this problem I will explain with indexation and without indexation and how the SSC is deciding which is the least tax liability. So problem, Mr. L, a resident individual, purchased a plot on 25,898. This is before 2001. So fair market value, we have to check the value. So the cost of acquisition was 40 lakhs. During the financial year 24-25 on 31/8/24. So this is after July 23rd. So we can use indexation and without indexation benefit. He had sold this plot for 2 crore 50 lakhs. Fair market value of that plot as on 1/4/2001 was 50 lakhs. He had acquired National Highways Authority of India bonds for rupees 40 lakhs. Calculate the tax liability of Mr. L in respect of the above capital gain, assuming that he has other taxable income exceeding the maximum exemption limit under the new tax regime. So two options available. Plot is sold on 31/8/24. That means after 22nd July 2024. So he can pay tax on LTCG at the lower of the following. Two options. One is tax at the rate of 20% of LTCG calculated with indexation of cost. Second is tax at 12.5% of LTCG calculated without indexation of cost. Now first option we will do full value of consideration. Full value of consideration. Full value of consideration, here there is no expense on sale. So 2 crore 50 lakhs. 2 crore 50 lakhs. There is no expenses on transfer. So this is the net sale consideration. Net sale consideration is this value. Now less cost of acquisition. Cost of acquisition. He has purchased for 40 lakhs in 98. Actual fair market value is 50 lakhs. Whichever the higher value we will take. So 50 lakhs, index cost of acquisition, 50 lakhs into 363 divided by 100. There is no index cost of improvement. So this value is 1 crore 81 lakhs, 1 crore 81 lakhs, 50,000. 50,000. So your LTCG is 68 lakhs 50,000. 68 lakhs 50,000. 50,000. Now he has invested in National Highways Authority of India bonds for 40 lakhs. So here 40 lakhs. So his taxable long LTCG, is equal to 28 lakhs 50,000. Now we have to calculate the tax liability for this. So this is with indexation. Now tax liability, you know that earlier regime long-term capital gain is charged at 20%. So tax liability 20% of 28 lakhs 50,000. 50,000, the value is 5 lakhs 70,000. 5 lakhs 70,000. Now add surcharge if any. Here there is no surcharge because his income is not exceeding 50 lakhs. It's not mentioned. So no surcharge. But higher education says 4% you have to add on 5 lakhs 70,000. The value is 22,800. Now total tax liability is equal to 5,92,800. 5,92,800. So this is with indexation is tax liability. Now second is we will do without indexation. Without indexation, full value of consideration 2 crore 50 lakhs. There is no expenses on transfer. So this is the sale consideration. Now he purchased for 40 lakhs in 88. Fair market value 50 lakhs. So the higher value we have to take. So cost of acquisition 50 lakhs. So the LTCG is 2 crore. 2 crore. Now exemption under section 54 EC. Under section 54 EC the value is 140 lakhs. 40 lakhs we have to reduce. This he has invested in National Highways Authority of India. So taxable LTCG 1 crore 60 lakhs. Now we have to calculate the tax liability for this. Now 1 crore 60 lakhs. So now we have to calculate the tax liability. The tax liability we have to calculate, that is 12.5% of 1 crore 60 lakhs. The value is 20 lakhs. 20 lakhs. Now surcharge at 15% because it's exceeding 1 crore but not exceeding 2 crore. So surcharge is 1 crore. 15%. 15% surcharge. Surcharge 15%. Surcharge 15%. So that is 3 lakhs. 3 lakhs. Now we have to add 4% higher education cess. 4% higher education cess on 23 lakhs, that is 4% higher education cess. Higher education cess 4%. So that is 92,000. So total tax liability 23 lakhs 92,000. So this is the tax liability without indexation. Now we have to do the deciding factor. How you will decide the deciding factor? First tax liability is with indexation 5 lakhs 92,000. Without indexation it is 23 lakhs 92,000. So income tax you have to remember always wherever we are getting the least tax liability we will accept. So this will be the assessee will be deciding to go for with indexation. So this is helpful, and as per the new tax regime, if the asset is sold on or after 23rd July 2024, this option is possible for the assessee, and you may also get questions based on this. So we have to do that. This is what I wanted to explain in this module. Happy learning. Thank you.